said that what is alternative investment, which is non-traditional, like mutual funds, stocks, real estate, everything is something like a very traditional one, and a non-traditional one something like crypto, or maybe if we invest in a fractional real estate, or maybe something like the product which we are doing. So this asset financing and all those are actually alternative investment asset class, and those as asset class is actually creating now the difference in the market in your portfolio. Ideal question now, maybe it's come in your mind that what should be a ideal allocation of my investment for of alternative investment into my entire portfolio. See, I am representing a company which is investing into alternative investment asset class, promoting alternative investment asset class, but I'll never ask you to invest their entire portfolio money to any kind of alternative investment. You need to understand the intrinsic risk which any kind of alternative investment have. But yes, to understand your entire portfolio value, to create a proper return and value, I would recommend you should invest 15 to 20% of your entire portfolio as a in alternative investment assets, in a different alternative investment assets. So this is a more or less ideal portfolio look. Next thing is more important. Yes, I agreed with you, Kaushik, that I'll invest. I'm ready to invest 20% of my entire investment. If my portfolio size is 1 crore, I am ready to invest 20 lakhs. But how do I select, this 20 lakh of investment into different portfolio, different asset class? If I say mutual fund or stocks and everything, but yes, here, what are the things I should consider before make an investment into any kind of alternative investment? Number one point, which is ticket size. Why ticket size is important? That if a small ticket size is there, that means the more participant into that particular asset class. That means the risk which you people are taking, which will be diluted, which will be much more lesser, or more people is actually buying that particular asset class. So your transaction possibilities will be higher. Okay, that's a first point. Second point is a risk profile. The asset where you are investing in and what is your risk profile, that has to have a balance. If that doesn't have a balance, the problem is maybe you are a completely opposite, a conservative risk taker, and you have somebody came and said that, sir, you can invest in a venture equity funding and you get a return of 5x within 5 years. 5x, I'm talking about 5 times. If you are ready to invest 20 lakhs, it will be 1 crore within 5 years. You have made investment, but you need to understand that what is the asset where you are investing. There has to be a balance between your risk profile and the intrinsic risk of that particular asset. Number third point is the security, where you are investing the money. If you are investing the money, what are the underlying assets which is covering up properly? For example, if you are investing, just I am giving the example of venture capital funding. If you agree to invest in a startup, what is the asset? Is there any asset which is actually covering up your investment? No, it's a completely high risk equity investment. If it is a fractional real estate investment or a real estate investment you are making in, then is there any physical security linked? Yes, it is. That the asset or the property where you are investing, that asset or the property is actually in directly or indirectly in your hand or in your name, so you can liquidate that asset. So that physical security you have to consider. Number fourth point is the return. Of course, alternative investment, whatever it may be, people can say anything, but I can tell you that nothing is a low risk. It's a average or a medium risk instrument. Alternative investment asset class as a whole, I'm talking about. Then if you were taking a little bit of higher risk than any competitive this called relatively competitive traditional investment, then the risk reward ratio should be optimized, right? So you have to understand that the risk reward ratio, what risk you are taking, what additional risk you are taking, and are you getting that additional return out of that? That the fourth point you need to consider. And the last point is exit. Whenever you are making an investment, how long is the lock-in period? Is it that I am getting my money back from next month, or maybe if it is a lock-in for a certain period of time, then how can I liquidate that? Is it some other third party is already ready to buy that? I think somebody has answered that unsecured or this equity, right? Unlisted equities, right? So if you, let's say you buy Paytm equity, first, and then you thought after 5 or 6 months or 1 year that I want to go out from that investment, how will you liquidate that? Who are the buyer or who can be the buyer? Those things you need to consider before making any kind of an investment. So these five things, five fingers, five things always you should keep in your mind before making any kind of an investment. I think, of course, more or less for the this alternative investment, a few things are also consider, you can consider for your this traditional investments as well. Now the most important part before proceeding further, this risk profile. I talked a lot about risk. Two three important points. Generally, this is the scale. If we talk, then 20% and below risk score person is actually a low risk taker, 50% is a moderate, and 100% is a high. And if it is something between 20 to 50%, that's a moderate low risk taker. And if it's 50 to 100, that's person who is a moderately high risk taker. I want that you should keep these pointers in your mind, because in our next slides or during my entire presentation, this slide or this number will actually help you to understand. I would also suggest that please contact Siddharth ji if you need to do your own risk profiling properly and understand that what is your risk score, and then accordingly take an investment call. So that's a point. So risk profiling, we talk about the five things to be considered, and then the risk score. Now the most important part, these five things which we consider as an alternative investment asset class directly: bill discounting, P2P lending, fractional real estate, VC and angel investing, and asset financing. So these five things which we thought that we can take into consideration. This is a kind of a a mainstream, at the same time sorry, or in alternative, a kind of a mainstream alternative investment. These are the mostly or more usable asset class in alternative investment asset classes. Now, just understand this slide. If I consider bill discounting, P2P lending, fractional real estate, VC and angel investing, and asset financing, and the five categories which I talked about. Ticket size. The minimum ticket size for bill discounting is 50,000. P2P lending is 10,000. Yeah, and everything is in rupees. So please consider it as an Indian investment value. Fractional real estate, it is 25 lakh. VC and angel investing, again, it's 25 lakh. And asset financing is a 20,000 on an average. Risk profiling, for intrinsic risk profile, I'm talking about for every asset class. For bill discounting, it is moderate. It depends upon a lot of P2P investment schemes, but average I can talk about moderate. Fractional real estate is a moderately low investment. VC and angel investing is a high risk investment, and yeah, asset financing is a moderately low investment. Security backed, is there any security backed into the entire investment? Apart from fractional real estate and asset financing, there is no security which is backed. P2P lending is directly said, that's a completely unsecured one. So asset financing and fractional real estate, when you make some investment, some platform, asset financing platform like us, which we are creating, where you hold the asset and you have the opportunity to, if anything goes wrong, then you have the option to sell those assets and make your money recovered. Next is the return on investment. If you can see, those for bill discounting is 10 to 12% CAGR I'm talking about, or IRR, I would rather say. P2P lending 14 to 20%. Fractional real estate, it is 8 to 12%. VC angel, the most high thing, 3x to 10x. I mean, multiplied 3x or 10x. Asset financing is at 12% to 18%. Ease on exit is how easily you can exit on the venture or from the investment itself. From bill discounting, no, it's not easy on exit. Why? Because when you have purchased a bill, you have to wait that bill to be, expired, and then you get your money back. For P2P lending, yes, it's easy on exit. You can stop your investment at any point of time. Fractional real estate, no. You own that asset, but depends upon the market scenario and everything, is difficult to sell a high value real estate property. Again, VC and angel investing, no, it is not at all easy on asset, because easy on exit, because again, the business startup SMEs where you have invested, your money is actually handling by some others, startup founders, and you don't know that what is the proportion of the future, or what kind of a thing happened, then yeah, it's difficult to exit. You have to wait the startup founder to take a call when they will go for the next round of funding, and you can make an exit. Last is the asset financing. Yes, again, it's a easy on exit. Why? Because you hold that asset, something like this P2P lending, you can make your transaction started from next month onwards, and you can make an exit at any point of time. So To considering all those picture and everything, we have decided to start investment opportunity. Underlying asset is a